Thanks for clicking! The London and St. Thomas Association of Realtors, LSTAR, has just released its data for the first month of the year, showing a real estate market that is eerily similar to that of January of 2023.
Well, it's Groundhog Day.
Yeah, as we'll see today, it's certainly starting to feel like it. And it's not just London's data that is starting out very similar to 2023. As we remember last year, analysts were predicting how fast the Bank of Canada would be cutting rates, with experts saying that we would be seeing a 4% policy rate by the end of 2023. Which obviously didn't happen. And then of course we're all seeing the headlines predicting very much the same thing this year.
It's different this time, I feel it.
Yet, we are receiving more and more data as of late, showing that rate cuts may not be coming as soon as the usual suspects have been promising. So, what I want to do today is go over London's real estate data for the month of January, take a look at some of the major similarities that we're seeing between this market in 2024 and that we saw in 2023, and then go over some potential differences. The spring real estate market hasn't technically started yet, but it's about to, and we'll obviously continue to track that market on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price, if you'll remember, that's the price of a home that represents the most popular set of features. The benchmark in December was sitting at $571,200 and jumped up a little more than $2,000 to $573,300. So the benchmark price was up a little over $2,000 in January, but up less than 1% since January of last year when it was sitting at $568,300.
Once in a lifetime opportunity here.
Yet, while the benchmark price was up, the average price of a home dropped in January. The average price in December was $614,887, and that dropped a little over $11,000 to $603,011. So that's a drop of about $11,000 in the average price in January of 2024, but the average is still up about $40,000 since January of 2023, or about 6.5%. And the median price dropped as well. The median price, that's where half as many homes that are sold over that price and half as many are sold under that price. The median price in December was $586,500, and that dropped down $11,500 to $575,000. So again, the median price down about $11,000 in January of 2024, but still up about 4.9% since this point in time last year. And the drops in the average and median prices make sense when you look at the sales to list price ratio, which measures by how much over or under asking a home sells. So if a home is listed for $100,000 and sells for $95,000, the SLPR would be 95. The SLPR in December was sitting at 97, and as of January was sitting at 97.4. So homes are still selling under asking price, but less so.
I'm negotiating.
And finally, the months of inventory measurement, the MOI, which measures if no more homes came to market, how long would it take for London to completely run out of homes for sale. The MOI in December was 3.8, and that dropped right down to 2.9. So if everyone just stopped selling their homes, London would completely run out of inventory in 2.9 months. So we have the benchmark price up about $2,000. We have the average price down about $11,000. The median price also down about $11,000. Homes are still selling for under asking, and we have a bit less inventory on the market than we did in December. But what does all this mean for prices heading into the spring real estate market?
Gonna be amazing!
Well, as we saw earlier, we're starting off remarkably similar to where we were in January of 2023. And we can see that very much when we look at the current level of supply compared to the current level of demand. In terms of new listings, in terms of the amount of inventory coming to the market, in January of last year we saw 543 new listings, and that jumped a little bit to 583. Not a major increase. In terms of aggregate inventory relative to demand, it's the exact same that it was last year. Last year in January, our MOI was 2.9, and as we just saw, it's still sitting at 2.9. And finally, the sales to new listing ratio, which measures how many new listings are bought up when they're listed, is actually worse than it was last year. Last year, the SNLR was sitting at 46.3 and is now sitting at 52.7. So, over half of the homes that came to the market in January were in fact sold. So, in terms of supply relative to demand, London looks very similar to where it started out in January of 2023, and we all know what happened after that, with the benchmark price rising almost $60,000 until June, and of course thereafter, when rate cuts weren't coming, it came back to earth. And mortgage rates are sitting exactly where they were last year as well. Last year in February, a decent 5-year fixed rate was sitting at 4.99, and fast forward to this year, it's still sitting at 4.99. So, the mortgage rate and mortgage qualification, the ability to purchase, is going to be the exact same as it was last year. And with FOMO in full swing, both from the media and from the usual suspects, as of right now, it is a possibility that we see a repeat of last year. With that said, there are a few differences between this January and January of 2023. For one, London's unemployment rate has inched up since this point in time last year, when it was sitting at 5% compared to the 5.6% that it's sitting at this year. I'm not sure that a 0.6% increase in the unemployment rate is enough to cool down demand substantially, but it's still an increase in the unemployment rate nonetheless. Further, there is a bit more certainty on the pace of interest rate cuts. With hot US economic data, hot US jobs data, and hotter than expected Canadian GDP data, it doesn't look like rate cuts are coming in time for the spring market. And given how wrong the usual suspects were last year, it's going to be even more difficult to convince the population of the same thing this year.
The Joseph Goebbels playbook.
And finally, as we've discussed before on this channel, last year's hot spring market was brought on not by the stellar sales ability of local realtors, but by the major drop we saw in mortgage rates, brought on by lower bond yields, which was brought on by the US banking crisis. Are we going to see something similar happen this year, where a major crisis pushes down bond yields, sending mortgage rates down? Stranger things have happened, but it's obviously unpredictable. So, in summary, before the spring real estate market starts, the January market is looking eerily similar to that which we saw a year ago. Prices are up, though marginally, supply and demand is about where it was a year ago, and mortgage rates are the exact same. Yet, there are indeed some differences. We do have a cooling economy, not by as much as I think the Bank of Canada was intending, but cooling nonetheless. It is looking more and more like those interest rate cuts that were promised by the TikTok realtors won't be coming anytime soon, definitely not in time for the beginning of the spring market, and mortgage rates are still higher than they were at the height of the market last year. With that said, we will continue to track the path of interest rate cuts and what's coming out of the Bank of Canada and how that affects us here in London. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.